Money management. Suppose you and I bet a penny on a coin flip, tails, you win, heads, you lose. Suppose you have $10 of risk capital and I have $1. Even though I have less money, I have little to fear. It would take a string of 100 losses to wipe me out. We can play for a long time, unless two brokers get between us and drain our capital by commissions and slippage. The odds will dramatically change if you and I raise our bet to a quarter. If I have only $1, then a string of only 4 losses will destroy me. If you have $10, you can afford to lose a quarter 40 times in a row. A series of 4 losses is likely to come much sooner than 40. All other factors being equal, the poorer of two traders is the first to go broke. Most amateurs think that other factors are far from equal. They consider themselves brighter than the rest of us. The trading industry works hard to reinforce that delusion, telling traders that winners get the money lost by losers. They try to hide the fact that trading is a minus-sum game. See Section 3. Cocky amateurs take wild risks, producing commissions for brokers and profits for floor traders. When they blow themselves out of the market, new suckers come in because hope springs eternal. Survival first. The first goal of money management is to ensure survival. You need to avoid risks that can put you out of business. The second goal is to earn a steady rate of return, and the third goal is to earn high returns, but survival comes first. Do not risk thy whole world, is the first rule of trading. Losers violate it by betting too much on a single trade. They continue to trade the same or even a bigger size during a losing streak. Most losers go bust trying to trade their way out of a hole. Good money management can keep you out of the hole in the first place. The deeper you fall, the more slippery your hole. If you lose 10%, you need to gain 11% to recoup that loss, but if you lose 20%, you need to gain 25% to come back. If you lose 40%, you need to make a whopping 67%, and if you lose 50%, you need to make 100% simply to recover. While losses grow arithmetically, the profits that are required to recoup them increase geometrically. You have to know in advance how much you can lose when and at what level you will cut your loss. Professionals tend to run as soon as they smell trouble and re-enter the market when they see fit. Amateurs hang on and hope. Get rich slowly. An amateur trying to get rich quick is like a monkey out on a thin branch. He reaches for a ripe fruit but crashes when the branch breaks under his weight. Institutional traders as a group tend to be more successful than private traders. They owe it to their bosses, who enforce discipline. See Section 14. If a trader loses more than his limit on a single trade, he is fired for insubordination. If he loses his monthly limit, his trading privileges are suspended for the rest of the month and he becomes a gopher, fetching other traders cover fee. If he loses his monthly limit several times in a row, the company either fires or transfers him. This system makes institutional traders avoid losses. Private traders have to be their own enforcers. An amateur who opens a $20,000 trading account and expects to run it into $1 million in 2 years is like a teenager who runs away to Hollywood to become a pop singer. He may succeed, but the exceptions only confirm the rule. Amateurs try to get rich quick but destroy themselves by taking wild risks. They may succeed for a while but hang themselves given enough rope. Amateurs often ask me what percentage profit they can make annually from trading. The answer depends on their skills or lack of such and market conditions. Amateurs never ask a more important question: how much will I lose before I stop trading and re-evaluate myself, my system, and the markets? If you focus on handling losses, profits will take care of themselves. A person who makes 25% profit annually is a king of Wall Street. Many top-flight money managers would give away their firstborn child to be able to top this. A trader who can double his money in a year is a star as rare as a pop musician or a top athlete. If you set modest goals for yourself and achieve them, you can go very far. If you can make 30% annually, people will beg you to manage their money. If you manage $10 million, not an outlandish amount in today's markets, your management fee alone can run 6% of that, or $600,000 a year. If you make a 30% profit, you will keep 15% of it as an incentive fee, another $450,000. You will earn over $1 million a year trading, without taking big risks. Keep these numbers in mind when you plan your next trade. Trade to establish the best track record, with steady gains and small drawdowns. How much to risk? Most traders get killed by one of two bullets: ignorance or emotion. Amateurs act on hunches and stumble into trades that they should never take due to negative mathematical expectations. Those who survive the stage of virginal ignorance go on to design better systems. When they become more confident, they lift their heads out of the foxholes and the second bullet hits them. Confidence makes them greedy, they risk too much money on a trade, and a short string of losses blows them out of the market. If you bet a quarter of your account on each trade, your ruin is guaranteed. You will be wiped out by a very short losing streak, which happens even with excellent trading systems. Even if you bet a tenth of your account on a trade, you will not survive much longer. A professional cannot afford to lose more than a tiny percentage of his equity on a single trade. An amateur has the same attitude toward trading as an alcoholic has toward drinking. He sets out to have a good time but winds up destroying himself. Extensive testing has shown that the maximum amount a trader may lose on a single trade without damaging his long-term prospects is 2% of his equity. This limit includes slippage and commissions. If you have a $20,000 account, you may not risk more than $400 on any trade. If you have a $100,000 account, you may not risk more $2,000 on a trade, but if you have only $10,000 in your account, then you can risk no more than $200 on a trade. Most amateurs shake their heads when they hear this. Many have small accounts and the 2% rule throws a monkey wrench into the dreams of quick profits. Most successful professionals, on the other hand, consider the 2% limit too high. They do not allow themselves to risk more than 1% or 1.5% of their equity on any single trade. The 2% rule puts a solid floor under the amount of damage the market can do to your account. Even a string of 5 or 6 losing trades will not cripple your prospects. In any case, if you are trading to create the best track record, you will not want to show more than a 6% or 8% monthly loss. When you hit that limit, stop trading for the rest of the month. Use this cooling off period to re-examine yourself, your methods, and the markets. The 2% rule keeps you out of riskier trades. When your system gives an entry signal, check to see where to place a logical stop. If that would expose more than 2% of your account equity, pass up the trade. It pays to wait for trades that allow very close stops, see Chapter 9. Waiting for them reduces the excitement of trading but enhances profit potential. You choose which of the two you really want. The 2% rule helps you decide how many contracts to trade. For example, if you have $20,000 in your account, you may risk up to $400 per trade. If your system flags an attractive trade with a $275 risk, then you may trade only one contract. If the risk is only $175, then you can afford to trade 2 contracts.